Okay, hello everyone. So today what we're going to be getting up to is doing a bit of technical analysis. And the main reason why we're going to be doing a bit more technical analysis is because I've had quite a few students want to see more about how I perform my analysis on all of my trades. So obviously, I'm sure quite a few of you know me. My name is Morgan. I'm the founder of MS Equities Trading. And what I do is I teach people how to trade from around the world. I teach people in about 25 countries around the world. But also what people know is I'm very transparent about my trades. So people can see my entire track record. I mean, you can see if you want to email us, we'll send you our entire track record, my investment reports, everything. But also the biggest one is on Twitter, there's a live feed of all of the trades that I execute. So my wins, my losses, everything. And a lot of people see, I've got like 300 pip moves, 100 pip moves, 20 pips moves, but they can see sometimes I can take down like 1,000 pips a week worth of trades. So a lot of what I've been asked is more about, what are you doing to get to those numbers? And obviously I'm not going to show you everything because this is what my students pay me to teach them, and I only take about 200 students a year. So I run a very small group. So basically I'm going to run you through a step-by-step technical analysis process. I've got a list of about 10 things that I've picked out from this trade. I'm actually currently in this trade on both of my trading accounts, and I'm short and I'm long at the same time. So what you're going to see is basically I'm going to take it a step-by-step process, run you through the 10 step points. This is all for educational purposes. Please don't go and jump in this trade just because I told you to. But if you go and do your in-depth analysis, you use your own strategies and you find something that works incredibly well for you and you make money for it, then that is great. These are part of what I want to do with these videos. So just once again, just to stop you quickly, if you do want to have more educational content every single week coming out, we're uploading about 2 educational videos per week. So if you want to, there should be my logo on the bottom corner of the screen. You can click on it, click subscribe, so at least then you can see the weekly uploads we're actually putting out. So you can see there's a previous video I uploaded about how much to use when starting to trade. Really nice video, you can pop on over to watch that as well if you want. But what we're going to do for this video, 10 steps about this currency pair that we're going to analyze. We're going to explain exactly how I came up with the 10 steps, and then hopefully we'll end off this video pretty fast. So hang on tight, and we'll get done with this video soon. Okay, so just to start off with, what I'm going to do is speak to you more about the technicals of it. And like I said in a previous video where I showed about inter-range trading, I said I can't really get into the fundamentals, the macroeconomics of it, because that takes a huge amount of digesting, of talking. The video can run on for about an hour. So what I'm going to do is run you through 10 short points about exactly what I discovered on this trade, and then I'm going to use the 10th point as a bit of a dip into the macroeconomics of it and the fundamentals of it. So this is going to be a Forex currency pair that we're going to be trading. It is the Euro Aussie dollar pair. I'm going to be trading it on a mid to long-term swing trade, so anything between 12 weeks to 36 weeks. Now everyone has their own point of view of what's mid-term and long-term, but this is between 3 months to 9 or 10 months. Long term, I always say it's holding for longer than a year. So it's going to be a sell position. So I'm going to be going in on a sell order on this position. It is going to be on a pivot point strategy. So pivot point strategy basically is one of the strategies I use where I'm basically looking for a market that is in extreme levels of being overbought and oversold. So it's moving in, let's say, a bullish mode, and I'm waiting for it to turn bearish, so meaning it's going to pivot. There are multiple strategies that I've layered on top of this pair to decide if it's a good pair or not, but I call it the pivot strategies. So I've used about 6 different strategies that I also teach my students, and I've come up with my analysis of this pair, which is why I'm actually trading it already. So the confirmation that I've gotten, the big confirmation, is on the monthly pair. So I've gotten a very, very strong confirmation from the monthly charts, which I've been happy to find. And then the time frame, like I said to you, is going to be anything between 3 to 6 months. So basically what I'm going to say is I'm starting off with firstly identifying the ranges I'm working within. Okay, so we're going to run through these 10 points, but first point is going to be the range. So on the charts here, you can see it's the Euro Aussie dollar pair, and I've got selected and highlighted the range A and range B. So as you can see right on in range A on the left hand side of the screen here, excuse me, this range lasts from 2001 through to 2007. So if we count every single year, it's a 7-year range followed by this strong move into this upper region here. Now, something I must please urge to you about this point here is this is during the financial crisis of 2007, 2008. So these are incredibly extreme levels, which we can't necessarily identify to be, what would I say, sane movements in the market. The euro currency pairs took a massive hit going into the last end of 2008. So that's pretty much what we're seeing on this pair right now. And you can see obviously going against a very strong pair like the euro. The euro is the second strongest currency in the world that you can trade. So basically what I'm going to do is try and move around this massive spike and this pivot point here. So as you can see, this range, the initial range, range A, is 7 years long, and the range averages 2,000 pips from top to bottom. So if I have a look here, that's about 2,100 pips, and I have a look right at the bottom here, that's just on 2,000 pips. So price movement over a 7-year period moves within a 2,000 pip range. And this is what I tend to find on currency pairs where there's not a massive reason for it to move, like there's a massive banking crisis or economic crisis or something really out of whack with interest rates or QE or QT. In terms of the macroeconomics, if there's nothing major happening, I'm looking at the currency markets ranging between 1,500 to 4,500 pips at a time, averaging 2,000 pips at a time within their ranges. So what I can see here is this is a pretty average, pretty straightforward range on number A, followed by this massive spike between 2007 and 2008, and then this massive sell-off going right back down, and then a strong recovery. So as you can see, the strong recovery has gone to the previous support levels. So previous support has equaled, so past support is equaled new resistance. So as you can see here, there is a massive level of resistance and support here. So as you can see in this level here, we've got very strong support in this downward range, and now we are showing very strong resistance. And that is actually going to take us to point number 4. But now what we're going to do is talk about the average range from the range A and range B. So as you can see, range B is also showing very similarly. Okay, so what have we got here? It's averaging about 2,000 pips movement at a time. So as you can see, there was a bit of an extension over here, but you can see that it's extending into that 2,000 pip region from time to time. And that is also important for us to identify that this range, range B, let me just quickly zoom out here. Seems like I've lost range B's title. Okay, so range B is there. Okay, so range B, as you can see, that we're looking at the same thing, 2,000 pips on the average range. We're looking at, it's currently at 5 years worth of ranging from this point here, moving into the range, followed by this ranging. So you can even say it's about 4 years worth of confirmed ranging, but as you can see, it's moving in the range of about 2,000 pips. And these top points here are numbers showing how many months it's taken to get to that level. So it took about 7 months to get up to this level, took about 5 months to get up to that level, and about 11 months to get to this level as well. This movement up to the top has been a lot slower than the previous levels, but it has been quite a strong and gradual movement. You can see there's very little volatility to the downside. It's stayed on a strong upward trend. So basically what I'm also going to have a look at is showing that it is forming a very, very rough Gartley. Now Gartley is a technical pattern. I don't use Gartleys a massive amount, but it at least helps me see price structure. Now please go back to my previous video talking about trading into range It's a very, very important video. I talk a huge amount about price structure. Not going to talk about it now, but it's also important for you to go over. So as you can see, in terms of forming a Gartley, what we've got here is we've got a pattern moving down from this level, back up into this top level here, followed by a massive move back down, and then a move up to this region here. So what we basically got is this long bounce, massive spike, massive move back in the opposite direction, and then a recovery back to that previous support. So previous support equals past support equals new resistance. That's basically what the fundamentals of Gartley look like. And basically this price structure has helped us at least identify that there's still strong price action moving within structure and within its limitations. So what that basically means is that we know if we put technical structures over this, perform technical analysis, there is a high probability that we're going to have good abiding structure and good abiding price action if we try and use structure. So going into the next one is, like I said to you, the spike in 2007, 2008 is a massive financial crisis. So I'm not necessarily going to consider that as part of my analysis right now. But the big point is that obviously this previous range, range A, you can see on the left-hand side, is a strong point of price action. So if I use a simple example here, and we have a look at how price has moved from this level down into this level, you can see that there is an opportunity for price in the future to move back up into this previous range. Now that is something that I can't necessarily say up front, because that is quite a promising thing to say in terms of trying to identify if such a long-term range of 7 years is actually going to have price move back into that range again. For all I know, it's going to form its own ranges and never move to that previous price structure again, because it's such a long time frame as well. These are important things to understand as well. The biggest point that I've also got here is my stochastic levels. Now, people also know that I use trading the stochastic and the MFI quite a lot. Now, on smaller time frames, your MFI and your stochastics might not work as well to identify points of being overbought and oversold, but I tend to find in the much larger time frames, trading on the weekly or the monthly time frames, I tend to have very, very good opportunities where I can see that price is moving overbought and price will probably retrace at some point in time. And that's what I've identified here. So as you can see over here on the monthly chart, we have price that is showing it is overbought. So you can see right over here in this level, you can see that price is extremely overbought. And as you can see happening in the past, when price becomes overbought, what does it do? It retraces and it moves back into that lower level. You can see over here previously a strong retracement, over here strong retracements, and once again strong retracements. Now this is on the monthly time frame. Now my first point of point number 6 is the monthly is overbought. If I move into the weekly, let me just zoom out a little bit here, you can see the weekly is also overbought. And as you can see from time to time, there are very strong retracement points on the weekly time frame for the stochastic. Sometimes the stochastics on the weekly time frames might happen a little bit too soon, but it at least is a good identification point for us. Going into the daily time frame, which is also quite important, you can see that the stochastic is oversold once again. Now on the daily time frame, I wouldn't necessarily use the stochastic a huge amount if it's my only point of analysis. But what I do understand about these 3 points on the monthly, the weekly, and the daily is all 3 of them are overbought, which is actually quite an interesting thing because it seldomly has gotten to this point where all of the 3 large time frames have been overbought at the exact same time. So this obviously allows me to understand that there is a very strong opportunity for multiple time frame analysis as well. And I perform multiple time frame analysis a huge amount, which also helps me with understanding where the bigger trends are moving towards. So if I know that the bigger trends are overbought, I know that the smaller trends will probably either be overbought very soon or not move much higher at any point in time because the larger time frames are overbought and the trend might begin to retrace. Now, another point is that the MFIs on this time frame and the daily, the weekly, and the monthly are at no serious significant levels. Now, this is obviously a problem in my analysis because I use the MFI to identify overbought and oversold opportunities. But what I have identified about the Euro Aussie dollar is the MFI has very seldomly moved into the overbought and oversold regions. From time to time, the MFI will work on certain currency pairs and sometimes it will not work. As an example, on Canadian currency pairs, the MFI I tend to find works incredibly. On any Japanese yen pairs, the MFI also works well, and on a lot of pound pairs, not the pound US dollar, but quite a few of the other pound pairs, I tend to find the MFI works quite well. But on this pair, the MFI just doesn't seem to be moving into that levels. There's just not extreme levels of being overbought and oversold, and volume is just not moving to those levels. So basically for the MFI, I'm not going to be considering it for this analysis. Another point is the range lasting between 5 to 12 months from move of edge to edge. So basically what I do know is that should there be a massive sell-off in this opportunity, let's go to the monthly chart again, I'm probably looking for an outlook on this purple line of anything between 5 to 12 months for it to move bearish again. So that is also good for me because I at least know what the opportunity for my trade could possibly be. Now, as you can see on the previous pullback, there is two massive candles moving almost halfway into the range, followed by a spike back up to the top and quite a lot of volatility moving back down. As you can see in the past year, you also experience quite a lot of volatility, but very, very strong and long monthly candles. So that is also a very good point. When it comes to the oversold, especially right at the strong pivot points, you have big opportunities for strong bearish candles to form. So sometimes if you might get in early on the pivot of this point and hold it just for 1 or 2 months and make enough profit, then you can get out of the position, you can call it an end, and you can walk on to the next opportunity. So it's not like you have to hold this opportunity for 12 months straight. Another big one is that I've noticed multiple pivot points are occurring at the beginning and the end of the year. So if I just take this box away and I show you where the major pivot points are, as you can see over here, we have got a very strong pivot point. We have got hopefully another very strong pivot point. There are pivot points occurring over here as well as over here. So what you can see is that these lines on the screen are period separators showing us when the year has changed from, let's say, 2016 to 2017 as an example. So we know that at this point there was a new change of year, meaning a new year. You can go back into the analysis of this and realize that pivot points seem to occur. I don't want to move that. Pivot points seem to occur. There was not many happening here, but you can see there was a very strong pivot point happening there as well. So basically what I'm noticing is that the pivot points are occurring at the year's end and beginning. So right every 12 months, you're seeing massive turns in the market. And this is a big significant part because right now we're sitting at year end. We're sitting the 3rd of December. So that is also an important thing to understand, is that going back in time, our time frames are showing that it's pivots on very strong levels at the beginning and the end of the year. And that's where we currently are at, hoping for a pivot. So once again, these are the important parts about the analysis. These are the 9 points, but the 10th point is very important, which I really can just dip into slightly. I really can't talk too much about it because it is macroeconomic analysis. But the euro has had a massively strong year for 2016. The euro has probably outperformed most currency pairs in the market. The US dollar has weakened a massive amount, which certain people in the US economy are wanting to keep it as a funding currency, keep it as a weak currency. It can assist with investment and the stock market in itself. But the euro, in terms of its quantitative easing processes, Mario Draghi has really voiced a massive confidence going into 2017, saying that he feels that the euro currency can gain strength, can hold its strength, but there are a lot of contrarian views against this, knowing that there is a very strong opportunity given things to do with Brexit talks going into March and May of next year, as well as other macroeconomic outlooks and macroeconomic events happening that could very easily cause a strong pullback into the euro currency. Could the euro move into those higher regions? Most probably it could. But what I do feel is there is a good opportunity for price to move backwards, speaking on a macroeconomic perspective, not just on a technical perspective. In terms of my risk management analysis, that is a massive video all in itself. But what I wanted you to do is at least take some information from this video of how I'm performing my analysis. I am already short on this trade. I'm going to hold this position for a very long time. For yourselves, please make sure to do as much educational and an analytical information processing as you can on this currency pair. Please don't try and just enter on a trade if you think it's going to be a big opportunity for you. I'm just doing these videos for educational purposes. But once again, what I do want to say is there are a lot more videos coming out just like this one every single week. So what we're going to do is a technical analysis video every single week. I'm going to be doing a huge amount of other really awesome videos that are educational content that's going to help you with trading, investing, and wealth management. So if you really enjoy these videos, make sure to give it a thumbs up as well as subscribe so you don't miss the next videos coming out. Every single Sunday, we usually are uploading some really nice videos. So please make sure to check in every single week. Once again, everyone, I hope you enjoyed this video. I'll make sure to see you in the next one. Cheers for now.